welcome to this month's free WCMA, Wisconsin Cheesemakers Association member webinar. Today, we will be talking through a 2025 milk pricing forecast with our friends at Ever.Ag. But before we do that, I want to dive into a couple of housekeeping reminders. You're probably familiar with these from past webinars and other Zoom meetings, but please make sure your mic is muted and your video is off during the webinar, so we can reduce interruptions during our presentations. We will have time for Q&A at the end of today's session. So as you're going along listening, please feel free to drop your questions in the chat anytime, either to the full group or privately to me, and I'm happy to pose those at the end to our presenters. We will share a recording of this webinar as well as some materials and helpful resources and contacts later this week after the webinar concludes. So if you miss anything, don't worry, you will receive that in a follow-up email from me. With that, we'll take a quick look first at our agenda for today. First, before we dive into what next year looks like for milk pricing, we would be remiss if we didn't mention the ways WCMA has been heavily involved on members' behalf in the U.S. Department of Agriculture's proceedings to update outdated pricing formulas in federal milk marketing orders. Then we'll get to our featured guest speaker, Kathleen Wolfley of Ever.Ag, for a forecast of milk prices in 2025. To start us off, I'm happy to introduce John Umhoefer, WCMA's Executive Director, to talk more about WCMA's milk pricing advocacy in the last few years and what may be next in the process. John, take it away.
Thank you very much, Grace. I will be brief because I saw Kathleen's slides and they're excellent. So I just wanted to touch on the fact that you can't talk about milk price forecasting if you don't look at what the federal order has done in the last 2 years. They really are hand in hand because the government plays a big role in milk pricing in the United States, as I'm sure you know. So if I jump to the next slide, basically, I wanted to let you know that it's been about 4 years, even though the process is going to be about 2. We've spent about 4 years looking at milk pricing and updating the formulas and factors in the formulas that make up the cheese milk price, the 4 price class system that we have in the United States. And finally, it was March 2023 when WCMA and IDFA went to USDA and said it's time to ask for a petition to open the federal orders and talk about these milk pricing formulas. The industry jumped in, proposals were made, and in June we finished off, along with Dr. Mark Stevenson, a cost of production survey for all these products that make up the products used in the class 3 and 4 price, the butter, the cheese, the non-fat, the dry whey. The big hearing from August 2023 to January 2024, and last summer we had the July recommended decision finally come out from USDA, and that takes me to the next slide. So what you saw, and I'm kind of focusing on the class 3 prices, the increase in the make allowance on the 4 products. We're gonna have to click through these. Up about a nickel on all the products, and we had the retention factor move slightly up from 90 to 91%. That's the butterfat retained in the milk and the cheddar making. Importantly, the barrel cheddar price, as you know, removed from the DEP MRP, was the great acronym. That'll probably have, other than the make allowances, the second biggest impact on the price forecasting moving ahead. And then the composition changes in the milk, the recognition that components have changed in milk. Then one more click there, proteins, other solids, and lifting through time here. So then we moved on. We commented like everyone else this fall, and on November 12th, USDA released its final decision on milk prices. And thankfully, IDFA and WCMA defended the position that it's been 16 years since make allowances were lifted. That's a long time to have no price increase on the cost of producing these products. So we defended the position that this was necessary, this price increase, and that nickel that I mentioned earlier was slightly adjusted even higher. And you can see the final decision versus the proposed decision there versus what they are now for cheese, butter, dry whey, and non-fat dry milk. That slight increase for non-fat dry milk, about a penny, and that 1/15 of a cent for a marketing allowance for all 4 products, which used to be in, they took it out in the recommended decision and they put it back at USDA. and then the quicker turnaround on when they're going to apply the milk composition factors. So now we're into the final step. But let me show you two slides, and these are courtesy of Dr. Chuck Nicholson and Mark Stevenson at the University of Wisconsin. This is their take on where this will go from 2024 to 28. And this is just order 30, upper Midwest. So, and if you just looked at the blue-gray bars there, they see a net slight decrease in the overall milk price. And you can look at the last set of bars on the right and see that on average over those 5 years, about a 13-cent difference in where milk pricing would be versus today. I would say that because the order is taking on a slight decrease, that will offer the opportunity for some of the deducts you've seen in the upper Midwest to come off. And I think the net will be that there'll still be competitive price paid for milk similar to what you see today. And then the next slide looks more national from the professors. And here you see year one for them, I believe, was 2024, so a similar time frame. You see that class one what we see today, and class three pulls downward based on the make allowances. The net is basically the tiny blue bar. And if you look at the average, you're talking about pennies nationally, probably to scale about 5 cents difference between what the milk price would have been without this and what it will be after 2 years of hard work. So all of that for a nickel. And now we're in the last phase on the final slide I have of looking at the producer referendum. All of the work done in the hearing and all the decisions made by USDA go before dairy producers. As you know, each order votes on whether they want these changes. You have to have 2/3 of the producers say yes to the changes, or 2/3 of the milk say yes to the changes. If they do not, their order is actually voted out of existence. So ballots required from the farmers by December 31st and received by USDA by January 15th. And we would expect in January that the vote would be tallied and known. And I am expecting that these orders will be taken up across the country. And you would see in the second quarter, at an indeterminate time, perhaps April, perhaps May, that the orders would be written into federal law, and you would have them take effect. So that is a big piece of milk pricing, and I'm sure that Ever.Ag takes a look at that closely when it talks about its overall picture. But for the really big picture, I'm going to turn it over right now to Kathleen and get the bigger picture on the future. Thank you.
Well, great. Thanks so much, John, for that great introduction. Let me share my slides really quick, and we'll be off to the races. All right, well, I'm Kathleen Wolfley. I work with Ever.Ag. I'm the Director of Market Intelligence. I've been with Ever.Ag for 11 years now. Started my career with Leprino Foods and moved to Ever.Ag and have been there ever since. So excited to join everyone here today. So let's talk about what's going on in the dairy markets and what we expect to see going forward into 2025. But before we dig into too many of the details, let's talk about assumptions. What are some of the Ever.Ag assumptions as we go into next year? First thing, more milk. We expect to have more milk in 2025, but I don't think that the pathway toward greater milk supplies is going to be all that clear. I think there's going to be plenty of headwinds going forward, particularly as we look at the next six months or so. The second thing, the new capacity. Everybody's been talking about it for years, this new capacity coming online. It's suddenly a reality. And I think that there's potentially a lot of significant disruption that we're going to have to deal with as an industry, particularly on the cheese side and potentially a little bit on the butter side as well, as we fit this new capacity into the marketplace. The third assumption is a spotlight on exports. If we think about outlets for all of this new capacity that's coming online, exports are going to be a key focus for soaking up some of that potential surplus in the marketplace. And some of that is going to be, hey, let's stay competitive on price in order to keep those exports flowing. Fourth assumption is domestic demand. We suspect that domestic demand will struggle to start, but I think that the second half of the year could look quite a bit different than the first half of the year. And the fifth assumption is the way markets. They've been a big contributor to the class 3 values over the course of the last several months, and we expect that that strength could hold at least early on in the year. I'm getting a little bit of background noise, which is okay, but let's talk about cheese price landscape. What are the Ever.Ag expectations going into next year? First half futures are pricing around $1.80, $1.85. Full year futures around that $1.85-ish mark as well. And I will note I pulled these prices last Friday, so I think that futures have come down a little bit yesterday and into today. Our forecast, on the other hand, is in that mid 170s, low to mid 170s mark for full year. First half expecting somewhere around sub 170. What are some of the downside risks as we go into next year? I think more milk production is definitely on the table. More cheese capacity. As we look at the European and New Zealand prices, as those values are a little bit more competitive, does that keep our exports struggling to find traction into the international market? Plus, we have an iffy demand environment. Do we continue to see current soft demand continue well into 2025? On the flip side, upside risks, if we see pretty good exports, that could help to clear up some of the marketplace surplus. Lighter cheese inventories have been something we've been dealing with all year. That's definitely an upside risk. If these cheese plants are slow to launch, it's been so far, what I've heard is that things are going okay, but if we see some hiccups in terms of how quickly cheese plants can get up to speed, that could slow some of the potential for this new capacity coming online. And the last thing, domestic demand recovery. So in a nutshell, there's the key assumptions that are going into our forecast and what we expect the cheese price landscape to look like next year. Okay, so let's talk through some of those assumptions. First, milk production. We've finally seen milk production in the US turn positive, and we've seen it turn positive for 3 consecutive months after, I think, 13 months of consecutive declines in milk production. Avian influenza, certainly a concern as we are heading into October and now on into November. As we are looking at California in particular, it certainly had a drag on US performance in October. The folks that we've talked to suggest that November might be a little bit worse in terms of the impact on overall performance in the region. But as a whole for the US, even though we have seen impacts to production in California, other places across the country have more than offset some of those declines. Look at Texas, South Dakota, Kansas, Idaho. Those regions altogether, 3 of those 4 regions are seeing capacity expansion. And with that, we're seeing growth in milk production, growth in cow numbers to essentially push forward for that new capacity, those new capacity expansions. Again, we've seen cow numbers up about 10,000 head versus October of 2023. That's the first time that we've seen cow numbers up on a year-over-year basis in 17 months. So I think that setting aside the California situation, we are seeing growth in the US, and in part of that is being driven by this new capacity that's coming online. I want to talk a little bit about fat tests. I know John mentioned that we're seeing some adjustments in the federal order, just given the fact that we are seeing some shifts in just overall component levels at the farm level. But one thing I want to call attention to, and I know it's not really new news, but fat tests in the US continue to rise. Year to date through October, average farm fat tests were around 4.2%. That's up from 4.11% last year. And if we look at it on a high-low basis, so, okay, the low month for 2024 was somewhere around that, let's say 4.08%. The high somewhere around this 3.5% for the month. that low of around 4.08 is about the same as the high in 2019. So you can see that just over the course of a short amount of time, 5 years, we have seen significant expansion in how much fat is being produced at the farm level. And I think that's creating ripple effects across the industry. If we look at just a 12-month trailing basis, on-farm fat tests up by 2.5% roughly. That's at the same time that we've seen we saw milk production in the US down by about 0.3%. But just given the gain in farm fat production, that's enough additional fat coming off the farm to make about 100 carloads of butter per week. That's a whole heck of a lot of fat that's coming off the farm level. Why are we seeing some of these gains? And how are we expanding fat tests so quickly? I think we can look at genetics. We can look at, hey, producers have been paid a lot for butter fat over the course of the last couple of years, and it's every paycheck screams, hey, go and make more butter fat, push your cows for fat, nutrition, and just looking at cow comfort, ways that you can improve fat tests or component levels based on changes at the dairy level. So again, this is kind of old news, but still pretty remarkable in terms of how much additional fat is available in the marketplace today. As we go forward, our expectation for milk production into 2025 is that we will see more milk in the marketplace. Part of the reason why is that we've got pretty good margins at the farm level. I work with a lot of producers, and they would never tell you that things are not so great at the farm, but at least on paper, 2024 should be a pretty stellar year, the best margins. Again, on paper, going back a decade, 2025 today, based on futures prices, still another solid year, some of the best prices in a decade. Certainly we're off the highs in terms of expected margins compared to what we were pricing somewhere in that midsummer time period when cheese prices were quite strong. But still, $12 a hundredweight based on the DMC margin expectations on paper are some of the best margins we've seen in quite some time and should encourage a bit more milk in the marketplace. Shifting gears to the international marketplace, I think that the outlook here is pretty mixed. As we look at Europe, Europe has continued to struggle really for the last several months with the spread of the blue tongue virus. It's hit some regions harder than others, but overall, Europe has been struggling for a good portion of the year. We do expect that some better margins on the table going into 2025, plus some weaker year-over-year comparisons should help to turn milk a little bit more positive in the EU. But that's certainly something we're going to want to watch pretty closely, as Europe is one of our key competitors. And as we think about the breakdown of milk supplies, Europe produces 1.6 times as much milk as the US. So what happens in Europe does have a broader impact on the industry in terms of just sheer availability of product. On the other hand, as we look at New Zealand milk production is off to the races this season. Season to date output running up about 4% on a volume basis, up around 5% on a milk solids basis year over year. In my estimation, barring any significant shift in weather patterns, soil moistures, or payouts, New Zealand supply should stay pretty firm on into early 2025. I think the key question for me on the New Zealand front is, given the global demand dynamics, think China, think Southeast Asia, what types of products are manufacturers going to focus on? If China isn't buying as much Homo powder, is New Zealand going to shift gears and maybe make a little bit more skim? Are they going to make a little bit more cheese? And how much of an impact might that have in terms of their competitiveness or their want to compete into some contested markets? So certainly a watch factor as we go into next year as well. Okay, that's the milk front. Let's talk about cheese capacity, our second assumption. It seems like we've been talking about new cheese capacity for years, and that talk is finally reality. Over the course of a couple months, we are going to see the Hillmar cheese plant open, and that started running milk a couple weeks ago. The Great Lakes cheese facility, I've heard is taking milk. Valley Queen's expansion is expected here within the next several weeks, and Leprino's expansion is expected to come in early 2025 as well. So after years of talk, reality is here, and we are making cheese at some of these facilities. These ramp ups are not going to happen in a snap, right? You're not going to take full volume into Hillmar or Leprino on day one. They are going to take a few months to ramp up, but we suspect that by midsummer next year, these facilities are going to be taking around 20 million pounds of milk per day, milk that's going into these new cheese plant facilities. Obviously, cheese demand and capacity do not necessarily grow in lockstep. You don't generally see a new cheese plant's worth of demand come online at the same time that new cheese plant turns the key and starts up. As a result, I suspect there is a chance that we could see some surplus supplies weighing on prices into 2025, where we see that new capacity outpace demand growth, particularly given the current sluggish demand situation. But I think that we should also be keeping an eye on potential for exits. Leprino has already noted that they're going to close a plant in California at the end of 2025. There have been other plant announcements for closures that we've been watching as well. So I think that there's potential that we are going to see new capacity, but also closures at the same time. But overall, these new plants are starting to run, and by next summer, we expect them to be mostly up to speed. I think the key question that a lot of folks are asking is, so, okay, we've got these new plants, where's all the cheese going to go? And I think that inventories may be a start. October stocks were sitting around 1.3 billion pounds. That was down about 8% from prior year levels. This is something that the market's been dealing with for several months now, that stocks have been running behind prior year pace. So I suspect that a portion of this new cheese that's coming online could find its way into cold storage facilities and refill some of that deficit versus prior year levels, and get us probably back to closer to where we have been running for the last several years. So that's one outlet for this additional cheese. The next outlet is the export market. We've been running hard on exports so far in 2024. We've hit record high levels, up 151 million pounds of cheese shipped. Mexico has been a key outlet for the U.S. On the cheese side of things for 2024. Year-to-date volumes up more than up to around 350 million pounds. Seems like each and every month there's been big volumes from the U.S. into Mexico. In fact, Mexico's share of U.S. exports has pushed up to 37%, which I believe is the largest market share that Mexico has taken of U.S. cheese exports going back to 2009. So Mexico has been a huge feature in our growth in cheese exports this year. And I think the big question now is, can we keep it up? That's going to come down to price, in my estimation. U.S. cheese probably needs to be about a 25 to 30 cent discount to the rest of the world in order to get the sale. We like to look at the CME barrel market versus the EU mozzarella market as really that indicator of our competitiveness. And I think on a spot basis, we're probably there at winning exports, at least on a spot basis. As we look at futures, though, futures are for the first half of the year around that $1.80 mark. The gap might be a little bit too narrow to really win big exports. That's not to say that we aren't going to continue to ship product. I think that we have put some good volumes on to start the year. But in order to stay competitive and to keep those exports hitting new record levels, I think that we are going to need to mind this gap going forward. And that could, as we see, if we see European prices come down, we could see US prices fall under pressure as well, just as we need to keep that gap from between the US and the EU to keep those exports flowing. On the butter side of things, I think this is another area of export opportunity that we're watching pretty closely. We've been in a pretty competitive position versus the rest of the world, the EU in particular, for several months, and that our US price was about $1 or better below the EU, really from midsummer on, both on a spot and a futures basis. The big question now is, can we ship more product into the international marketplace? Or will this recent downtick in Dutch prices start to squeeze some of those opportunities? I've heard that there's been plenty of tire kicking, maybe some volume getting booked into next year. But when we think about US butter exports, what they're looking for in the international market is an 82% unsalted product versus our 80% salted product. So to some extent, it's a bit of a hurdle in order to make those products for the export market. So it's really more of a make to order type situation. And given current dynamics, I don't know how much eagerness there has been for US manufacturers to really bite at those export opportunities. But we'll see here over the course of the next couple months. If we do ship a lot of product into the international market, that could help to level off some of the butter surplus that we've seen. A couple other things that we're watching from an export perspective. The US dollar is at the highest level in about 2 years. And when we think about the US economy, the US in general, there's a lot of things up in the air. There's a lot of headline risk that we've been looking at. Yet at the same time, the US continues to outperform other regions. When we think about the US dollar, all things being equal, generally a high US dollar is not bullish for ag commodities. It does make our product that much more expensive. So I think that that's one thing that we need to be looking at going forward as we think about our US export competitiveness. The other thing that we're watching closely is Mexico's peso. We have seen a pretty significant devaluation in the Mexico peso over the course of 2024, down about 17% year to date. Certainly lots of questions around, does Mexico have the purchasing power to keep buying at the levels that they have, buying dairy products at the levels that they have well into 2025? And the last thing on trade, I'll throw out there, we do have a Trump 2.0 presidency coming in 6 weeks or so. And there's been a lot of talk and rhetoric around potential for trade renegotiations and tariffs throughout the whole election process. USMCA, I will note, already has provisions to re-examine, review in 2026. Will we see the book reopened before 2026, or will we wait that far? There's certainly been a lot of talk about tariffs being levied on Mexico, given continued border crossings and border security and drugs coming across the border. I think that the big question is, if we do see these tariffs levied, will we see retaliatory tariffs in response? What type of products would retaliatory tariffs hit? If it hits the dairy industry, that could potentially be detrimental to our exports. But again, I think this is all very much in rhetoric phase, talk, not necessarily a reality at this point in time. And I think it should be noted too that the last time we came to the negotiating table and imposed tariffs on a country like China, Beijing did retaliate, but at the end of the day, the US ended up in a better position. We are shipping more product into China today than we were prior to the trade renegotiations. So all in all, I think this is something that we should definitely be watching closely as a potential for impact on the industry. But for right now, it's kind of wait and see mode. Shifting gears, let's talk about domestic demand. Total domestic consumption year to date, or total domestic per capita consumption in 2023, excuse me, was at an all-time high. We eat more than 42 pounds of cheese per person. That's up 5% over the past 5 years, 19% over the past 10 years, and 30% over the past 20 years. That is a whole heck of a lot of cheese. Here in 2024, though, it's been kind of a sluggish story. Demand growth, at least our back of the envelope math, puts it somewhere around a 0.5% gain year over year in use. That is the slowest growth rate going back to 2020. So while we do continue to eat a lot more cheese, the growth rate here in 2024 has been pretty slim. The consumer has continued to push for value. There's been certainly a lot of chatter around folks looking for a deal. And interestingly enough, I'll point to this Walmart data. Strong Q3 results of same-store sales up more than 5%. And Walmart says that a good chunk of that growth in same-store sales didn't necessarily come from their core consumer. It came from families earning $100,000 and up. So again, it's the whole broader economy. Consumers are looking for value where they can, and for a lot of consumers, they're finding that value at Walmart. Food service operators are in a similar position where they are trying to position for themselves toward value. We've seen McDonald's, Burger King, Chili's running really hot promotions, limited time offers to try to get people in the door. McDonald's has also noted that they are going to supplement the $5 meal deal that they've been running for a good chunk of the latter part of 2024 with a buy one, add one for $1 deal that starts in January. And importantly, the buy one, add one adds the double cheeseburger to the list of available items. And what's important about that is the double cheeseburger has not just one, but 2 slices of cheese. So if you think about it, say a double cheeseburger is $5 at a McDonald's. For an extra $1, you could add a second double cheeseburger. So instead of just getting 1 slice of cheese on your $5 meal deal, that's potentially 4 slices of cheese that you're getting by getting 2 double cheeseburgers. At the end of the day, how many people are going to go in and get 2 double cheeseburgers? I don't really have a good sense of that, but there is potential that some of these value deals could help to move the needle. Big pizza, that's another area that we're watching closely. It's a little bit mixed depending on where you look. Domino's did okay has been doing okay in 2024, but places like Pizza Hut, Papa John's have continued to struggle. I think one thing I continually hear from folks looking to go out and buy pizza for the family is, man, it is really expensive to get pizza today. And menu price inflation has certainly hit consumers in a tough way over the course of not just 2024, but combine that with 2023 inflation as well. Overall, people are a little tired with menu price inflation and just how much it costs to go out to dinner, and that may be chipping away at some growth in that region. With that, we are starting to see a bit of a consumer shift back toward grocery. Traffic into restaurants has been a little bit sluggish. Got a little bit of noise in here for the Thanksgiving holiday, but overall the trend has been a little bit sluggish on restaurant traffic, whereas grocery stores have continued to see some pretty solid gains here on the 13-week trends. Again, if you think about where is inflation hitting hardest today, we're really seeing it more so on the menu inflation in food service compared to grocery price inflation. The question here is whether this is a net positive or a net negative for dairy demand. But generally, I have to imagine that people are probably eating a bit more cheese when they go out to a restaurant versus how much they're putting on say, their pizza at home, or even compared to a frozen pizza. Looking ahead to 2025, I don't know as though we can say, hey, this soft demand is going to continue all the way into next year. Certainly, there are things that could continue to slow down the economy. We're still dealing with high inflation. There's certainly potential that with a new administration, we could see some noise going forward, at least early on. But as we look at some of the potentials for things that could turn the tide around demand, I think one thing we can clearly point to is gas prices. We are in a position where gas prices are down on a year-over-year basis. They've continued to slide. If we see with the Republican administration that there is more U.S. drilling, that could put a little bit more pressure on fuel prices as well. And we see that as almost an immediate relief for Main Street consumers, especially those that are traveling to work and putting fuel in their tanks. At the same time, we're looking at consumer sentiment ratings that are fairly steadily climbing. It was pretty choppy throughout 2022 and 2023, but we are in a position now where for much of 2024, we've seen those ratings continue to increase. That doesn't necessarily say, hey, dairy demand is going to be a lot better because consumer sentiment is better, but at least gives us an indication that maybe folks are starting to feel a little bit better. And the last thing that I wanted to touch on in terms of our assumption is the dry whey market. It's really been one to watch here in 2024 as we round out the year. CME spot prices crept above 73 cents last week. That's the highest level going back to March of 2022. And I think that we can continue to say that tight supply and sustained pull of whey solids into high protein manufacturing are helping to support that dry whey value. It's worth noting too that as we see some shifts on the supply side with plant closures and plant new capacity, there is potential for noise as we go into 2025 as well. But first, let's talk about the high pro market. It's not something that we talk about all the time, but I think that it does have some really important ripple effects as we look at the class 3 values. High pro is a key driver in this market as we think about dry whey values being supported. Demand in high pro for much of 2024 has really been running hot and heavy. Domestic use has been strong. Think protein bars, protein shakes. Export demand has been pretty solid as well. As a result, we are seeing WPC 80 plus prices trade in the high $4 range. WPI prices have been much higher than that, testing some new highs based on reports that we've heard. With that in mind, we have seen that multiple of WPC 80 to dry whey at well above average levels. So it's essentially encouraging high protein processors to prioritize high protein whey production. So think WPC 80 and WPI to take advantage of those strong returns. In our estimation, these high pro prices could last well into at least early 2025. And that could keep dry whey availability pretty snug and prices supported in that early 2025 time period. Why does it matter to the class 3 market? I think it has a sneaky big impact on class 3, looking at it from the big picture perspective. Over the past several months, we have seen these strong whey prices support class 3 in a way that we really haven't seen in several years. If we just look at October, the whey portion of the class 3 milk value near $2.25 per hundredweight. That's the largest contribution to class 3 that the whey portion of class 3 has given since 2022. And we estimate that in the first quarter of 2025, that whey portion of the class 3 value could account for around 15% of the value. So again, that's the most that we've seen really since that 2021-2022 time period. So something to look out for, as it does have a sneaky impact to the class 3 market. John walked through a lot of these changes as it relates to the federal order, but as he noted, 2025 does usher in changes for the federal order in a way that we haven't seen in quite some time. I'll walk through the changes quickly, but in perhaps a little bit more detail. First thing, the barrels are removed from the class 3 calculation. That essentially means that the protein component of the class 3 calculation will be solely based on blocks going forward. There is a chance that we could see potential for more volatility in the protein component once this change is enacted. Just as we think about, okay, with blocks and barrels being a part of the formula, we essentially had two prices that the average was being taken on. Now you have a situation where all of your eggs are in the block basket. So if the block market is volatile, you don't have that barrel market to kind of average things out. So that's one thing to keep in mind. But in general, I think as it relates to potential impacts of the barrels being removed and how that's going to flow through the class 3, I think it's kind of a wait and see mode around how things really shake out at the end of the day. Second thing is increased make allowances. John walked through these in detail of the changes, but these are essentially changes that we expected. It will lower producer pay prices relative to the current formulas. But these are the first time that we've seen these make allowances updated in 15, 20 years. The third thing is increased component levels for protein and other solids. This will lead to a higher class 3 number, but it's worth noting that in areas with multiple component pricing like the Midwest, producers are already being paid for their higher components. So in terms of producer pay prices, what they're seeing at the farm level, we don't expect to see any sort of major impact there. On the class 1 side of things, this is a return to the higher of class 3 or class 4. Again, this was an expected move from USDA, reverting back to the prior calculation. As the potential to have more or a bigger month-to-month impact, especially in heavy class 1 utilization regions like, say, the Northeast. But I think that over the long term, it will have a more limited impact. There are a couple other changes that John noted as well that I'm not going to go into detail on, but if you have questions on them, please don't hesitate to reach out. John mentioned this, but in terms of what's next, ballots are being collected now. Producers need to vote by the end of the year. I think everything needs to be in USDA's hands by January 15th. Cooperatives can block vote, and that's essentially a cooperative can say, hey, this is what our membership wants to do with the order. And this is essentially saying, hey, go or no go on the order. That's what the vote is for. And as John noted, the estimated implementation is Q2 of 2025. A couple other things to watch really quickly. Open interest. Heading into into year end, first half open interest is running about 20% behind prior year levels. Overall, it just doesn't seem like buyers have been all that excited about paying $1.80, $1.85-ish for coverage when spot prices have been trading quite a bit below that and new capacity is coming online. You just have to wonder here, will the calendar force some folks to act? And if so, will that lend a potentially supportive hand to the marketplace? Another thing to watch, holiday salad is not holiday salads, is salads, holiday sales. In this broader look at the environment where the economy remains on shaky ground, now I think it is interesting to see that holiday sales have been pushing higher, at least based on the early data. I think it is worth noting, though, that outside of 2008, Americans tend to spend more on the holidays each and every year. I think every year we've seen holiday sales increase with the exception of that 2008 timeframe. What that tells us about dairy, I don't have any great if this then that, but you have to wonder if maybe consumers are starting to feel a little bit better about prospects heading into next year, or perhaps they're just saying, hey, you know what? I've already got enough credit card debt. We'll just tack on to it. So I think that that's one to watch. And I have two wild cards to finish things up today. First wild card is avian influenza in California and the non-fat dry milk market. We didn't talk a ton about non-fat dry milk, but we have been running at a pretty steady premium versus the rest of the world for several months now. And I have to imagine that some of that premium is driven by the spread of HPAI in California, particularly hitting some of the key powder producing regions. Milk production in the state was down 4% year over year. The expectation is that the November data could be worse. So I think that this is one to watch as we think about potential spread, continued spread of avian influenza in California. And the last thing is China. It wouldn't be a dairy presentation if we didn't talk about China. They are the 500-pound gorilla in the marketplace. Milk production in the region is down about 7% year over year based on the data that I've seen. Stock levels are reportedly quite a bit lower. We have seen buyers a bit more engaged at GDT here in recent months, but square that with some domestic consumption figures that are still pretty weak, and you get a still fairly mixed picture out of China. The government is expected to roll out a bit more stimulus into 2025, but again, here hard to know how much of an impact this stimulus will have on dairy consumption in general. But my big question as we look at China is, do we see China come back into the dairy markets with big appetites in 2025? If not, what kind of competition might that bring out of some place like New Zealand, where they tend to sell a lot of product into China? If China isn't buying, what kind of competition for powder sales and perhaps even cheese sales might we see into contested markets from the likes of New Zealand? And with that, that's all I had for today.
Wonderful. Kathleen, thank you so much. Can you hear me? Let me just make sure my
Yep, we can hear you.
my mic is working here. There we are. Thank you so much. That was wonderful. So much good information. And I think folks are ready to digest and probably come at you with some questions. So first, let me share my screen here. We've got a couple of questions submitted in advance that I'm going to throw out there, and these may be for you. John, feel free to also jump in if you feel that it makes sense. So let's get started with these here. So we've talked in these discussions about FMMO reforms about the referendum, and that we expect that dairy farmers will approve the pricing changes. But what does the milk pricing landscape look like if that doesn't happen? Thoughts?
Well, Kathleen, we could both answer. You want to go first, or?
Sure, why not? I think that one thing to consider is that it would create disruption within the region if that specific region did not approve the federal order changes. But it does not change the underlying price formula changes. Those are final, those are happening. But this is a region to region vote on whether or not they approve that area. I think that say the Midwest decided to vote it out, it would look like Idaho, where you have an unregulated market, and folks have the ability to essentially make their own pay prices for producers, and they're not beholden to the pooling regulations that the USDA sets together.
Right. I completely agree. There's only a couple of regions where, the cheese and non-fat are so dominant that there might even be a consideration of not voting in the order. And like you said, then things would look a bit like Idaho, because you would be able to still refer to the class 3 price and the class 4 price, because it'll still live on in other regions. So like in Idaho, they use that class 3 and class 4 price to set prices in that unregulated area. And so, yeah, that's what it looked like. I don't think that this question will play out, though, if you're curious.
Not likely, we hope. We hope. Next question here is a good one. What impact, if any, do you think new sustainability requirements, trends in other countries could have on milk pricing next year? It does seem like sustainability measures are kind of the price of doing business more and more. And it's interesting to watch what becomes popular and required in other countries. But how do you think that could affect milk pricing specifically, if at all?
I guess I don't see it having a potential impact on broader milk pricing. If anything, I suspect that if a specific company wanted to have a XYZ sustainability requirements, you may see some premiums associated with those additional asks. But from a broad milk pricing standpoint, I guess I don't see any sort of major shift there. But I think you're right that this is something that we should be watching very closely here in the US, because those sustainability requirements, particularly in Europe, as we look at the requirements and the asks that are being put on producers, that is creating some potential margin squeeze in those regions for the producers. So I think as we think about potential for those sustainability requirements to shift toward the US, that could be a broader impact in over the course of the next many years.
Okay. So that is the end of our pre-submitted questions. So at this point, I'd like to open things up to our audience today. If you have a question that you would like to ask John Umhoefer of WCMA or Kathleen Wolfley of Ever.Ag, now is your chance. Feel free to unmute and pose your questions. If you need more time to think about it, or you'd like to submit it in the chat for any other reason, please feel free to do that as well. But at this point, I'll open it up. Anyone have questions for our presenters?
Do you guys feel, it seems like there's a lot of downward pressure opportunity and sort of upward pressure on class 3, given all the different variables that go into it? Just really generally, right? Just like, hey, it's flipping a coin. But like, I deal with customers asking me this all the time of like, well, do you think it's more likely to go up or go down? Do you guys have just a very general opinion on that?
Up or down from futures or
Let's say
from-
right now 2025 is looking like 19, right? Just say from futures.
$19 class 3. I think I'm going to take the under on that.
Perfect. Thank
There's my flip of the coin, but no, not really a flip of the coin though.
That's what I asked for. It's exactly what I wanted.
Yeah, no, I'm going to
think
take the I'm going to take the under on 19.
Yeah, I think there's downward price pressure given all the plant capacity, yes.
And I
Any
guess
questions?
to be more specific, I think that the bigger downside risk comes in the first half of the year, as the market works to absorb and essentially figure out, okay, we've got this new supply coming online. Can demand both from a domestic and an export market perspective and stocks absorb that additional product and just kind of sorting it all out.
Any other questions from our audience?
I have another one that's just super in the weeds.
I
for
think the floor is yours, David.
Chinese demand, do you have any insight into, hey, is the current level of Chinese demand for dairy mostly propped up by government subsidized purchases for their reserves, or is it actual like genuine consumer demand?
That is a weedy question that I don't have a good answer to. I think that's a great question though. Because there's certainly fluid milk programs in China. There's definitely been a push toward more dairy consumption, but I don't have a great sense for what's the leading demand driver.
Well, certainly on the dry side, it's animal feed, and that is a direct pass through. So that's getting to the animal. It's not being stockpiled necessarily. So, and that is the highest volume. It's not the highest value product we send there, but it is the highest volume. Is the whey products, the lower protein whey products.
Okay. Any other questions from our audience for our presenters today? Going once? Going twice? All right, if you think of others after the fact, please feel free to send them to me, or we will send out our presenters' contact information as well. So you will have opportunities to connect with them after today's webinar. Real quickly, before we close, I want to put in a plug for our next upcoming WCMA webinar that will focus on marketing with AI. We all know AI is a big buzzword lately, and it is in more places than you might think. So we want to cover ways that you can help harness that technology to improve your marketing efforts in your dairy processing business. That'll be Thursday, January 16th at 1 p.m. Central, and you can register for that right now at wischeesemakers.org. I also want to give a huge thanks to John Umhoefer from WCMA and Kathleen Wolfley from Ever.Ag for their presentations today. This was a very informative, engaging session, and really appreciate having you both on and giving some of your time and talents to our members today. So with that, I'll close our session today and say thank you. Have a wonderful holiday season, and we will see you for our next webinar in January.